Hello learners, I am Dr. Nidhi Mathur and the subject expert of this episode is Dr. Nidhi Mathur, teaching in National Law University, Jodhpur, Rajasthan. In the previous session, we discussed the foreign exchange markets. Today, we are going to talk about exchange risk measurement in detail. The globalization has led to opening of the world market for the business houses. The transactions of the business are not limited or restricted to a particular geographical area or man-made boundaries. The globalization and ease of doing international transactions has opened up new market and widened the scope of doing the business. The agreements between different governing bodies of various nations have been boosted in the recent past, and thus the global market has gained its importance for the survival and growth of the organizations. This liberalization of the international trade policies has led to various advantages and drawbacks. The main advantage of the global market is the production on the basis of the economies of the scale. The nations or the companies which are having comparative advantage in production of a particular product focuses on the production of that product and import the remaining products from other countries. Thus, this helps in reduction of the cost of the product as the production takes place at the locations where it is available at the lower price. The drawback of this process is that countries are not self-reliant and has a dependency on the other nations. Exchange risk and its characteristics. The global market also increases the risk associated with the business. The business houses having international transactions face the additional risk of changes in the exchange rates. Since international transactions involves trading with the different countries, the currencies used are different. The transactions in the currencies other than the domestic currencies of the country in which the company is located increases the exchange rate risk as the value of the currencies change due to various reasons. This impacts the payment liability and receivables that the company is expecting to get or recover. Thus, the business entered today at any specified changes when the actual transaction is taking place. The major risk factors in the foreign exchange trading are not limited to the exchange risk, but also involve interest rate risk, credit risk, operational risk, liquidity risk. The characteristic of the exchange risk can be explained in volatility of the exchange rate. The currency's values are volatile and changes every now and then. Thus, as the range or the time period of the operation changes, and the longer the time gap between the entering into the transaction and actual payment for the same, the risk is higher. This depends on the credit period allowed and operating cycle of the business. Time gap between receipt and actual put to use in business operations. The company A is having business transactions in a particular country and all the transactions are entered in a single currency. Then the receipts and payment will be entered in that currency only. The only impact over here due to the time gap will be the same value of money and the currency value shall remain same, which will impact the purchasing power due to time gap rather than due to change in the amount received. On the other hand, the company which are exposed to transactions with more than one currency has to keep a check on the currency value changes in the market. The time required for foreign currency is to be converted into the base currency or home currency of the company. The conversion itself is a transaction to exchange the foreign currency into base currency to be used directly for paying off the dues. The exchange rate is dependent on various factors not in control of the entity. The exchange rate depends on various factors both internal to the particular nation as well as external factors prevailing in the world. Thus, this rate is not fixed and keeps on changing, which exposes the company to the exchange rate risk. If the exchange rate increases and the company is required to pay in foreign currency, then the actual payment would be higher in terms of the base currency and thus the company will face a loss. On the other hand, when the company is required to receive the sum in foreign currency, then actual receipt would be higher and the company would benefit. This vice versa would happen in case of decrease in the exchange rate. Exposure to the exchange risk. There are various ways by which the companies or other organizations or even other investors are exposed to the change in exchange rate. This can be divided into various types depending upon the situation and impact of the change in the exchange rate, which are economic risk. The change in the economic conditions of the country impacts the exchange rate. The company investing the projects outside the domestic territory, then the value of that project is included in the value of the company, that is firm's valuation. In this case, the change in the value of the foreign currency would reduce or increase the valuation of the company as a whole. Here the actual exchange of the currency is not taking place, rather only the impact of the change can be seen in the valuation. The profit or loss may be incurred on actual terms in the value of the securities also, like shares, bonds, debentures, etc., which would impact the credibility of the company. The confidence of the various stakeholders is also impacted with the same. The value may change due to the change in the internal policies of the foreign country, which would make the product or service provided by the company cheaper or non-profitable for the company. Imposition of various other operation restrictions and limitations of various other types, which makes the operation in the foreign land non-viable. Thus, these types of economic risks are very high in case of investments from or to the foreign countries. This risk is also very rewarding, as the company will also gain a lot when the situations change favorably and the stakeholders gain due to rise in the valuation of the company. Contingent risk. The risk is also involved in the contracts or agreements that the company is planning to enter. The change in the rate of exchange impacts the profitability of the assignment, and thus the question on profitability of the project occurs. Suppose a company X in India wants to enter into a long-term arrangement with the company Y in Australia, then the proposed arrangement will be made in either the home currency of the Indian company or the home currency of the Australian company. Thus, any fluctuation in the currency prices of the Indian rupee or the Australian dollar would be beneficial for one party and leading to loss to the other party. In situations when the companies are expecting the immediate flow of fund, but due to exchange rate changes, the decision is delayed, which will impact the operating cycle of the companies. This risk is there due to difference between the companies located in different continents, and changes in the one continent will impact the company located in different continent. Transaction risk. The above two situations are not so common in the regular trading activities, but the most common risk is the transaction risk, which is faced by almost all the companies dealing in import and export of the goods or services. Any company having any international transaction has to face this risk. The basic risk that the payables would increase or receivables would decrease on the date of final settlement is known as the transaction risk. The companies enter into an agreement and price is decided beforehand for the goods or services to be provided, and thus the part of the payment is decided to be received on a future date as may be decided. The dominating company would influence to get the invoice prepared or agreement finalized on its home currency. Otherwise, generally the company supplying the goods or services prepares the invoice in its basic currency. The company which accepts the agreement in foreign currency is always in a doubtful situation as to what would be the final amount that will be realized. The proper study of the prices of the currencies and expected value is to be taken into consideration before entering in such agreement to make it profitable. Thus, to avoid such risk, the companies enter into the hedging agreements with the banks or financial institutions to convert their fluctuating cash flows into the fixed flows. Hedging can also be done through other small entities, also through bidding or other contractual obligations. Translation risk. The transactions, contingent and economic risk occurs when entering in a particular agreement or transaction. Some companies which have an establishment or entity in any form outside the domestic territory where the reporting currency is different, the holding company or the parent company has to face the risk of change in the valuation every time when the consolidated figures are required. The main company, whenever is required to report its financial results, whether annually or any other intervals like quarterly, monthly or half yearly, has to give a combined figure of all the companies which are included in the group company. The companies which have a different reporting currency as per their location and other preference is required to be converted to the base currency of the parent company. This involves using of the exchange rate. For different accounting terminology like assets, liabilities, incomes or expenses, different rates are chosen. Generally, the long-term assets are reported at the average rate or the transaction rate when the assets or liabilities were acquired or incurred. The income and expenses are recorded on the rate prevailing on the date of reporting or closing date. When current exchange rate is used for determining the value of the items in the financial statements, it comes under current rate method. When the historical exchange rate is used for the valuation purpose, it is called the temporal method. The choice of rate to be undertaken depends upon accounting standards followed by the reporting entity. The value of the company is dependent on the rate of exchange, and any adverse or unfavorable change in the same would impact the valuation of the parent company. Thus, the risk prevails that if at any time the exchange rate is unfavorable, then the value of the company would also reduce, leading to the reduction in the market capitalization of the company and impacting other stakeholders. Let us now discuss measurement of the exchange risk. The various studies have been done and techniques have been developed to measure the exchange risk. Since it is based on the future events, it cannot be measured accurately, but only a range of variations can be set. The studies of the past trends are very helpful in the same, as according to the variation and fluctuations in the past, the future variations and fluctuations can be estimated. The population distribution of the past may be taken for any time period depending on the time period for which the estimation is required and the factors which impacted the change in the past. The techniques used are of the variance and standard deviation, which gives mathematical calculations for the same. The other most common method used for measuring the risk is the value at risk model. This model helps in measuring the chances of the loss that the company may have due to the change in the exchange rate in the given normal conditions prevailing in the market. It measures the maximum loss when the market conditions are normal. For example, if the value at risk comes at $3 for 10% probability and 90% confidence, that means that in case of 10% of total number of days to the exposure, the loss will be more than $3, and on 90% of the days, the loss will be limited to $3 per day for the period. The change in the exchange rate is impacted mainly due to the changes in either of the three factors as per the economist, like purchasing power parity, interest rate parity and international Fisher effect. Managing exchange risk through hedging. The exchange rate risk can be managed by the companies through various hedging techniques like money market control, options hedging, forward contracts, future contract, swaps, home currency invoicing, leading and lagging payments. exposure netting, etc. The number of options are available with the management to determine the fixed exposure or particularly determine the net payable or receivables beforehand. The best method that is suitable to the management and which is also cost effective should be chosen. The cost is incurred in most of the hedging techniques involved, so the selection should be done prudently so as not to hamper the profitability of the company adversely. The regular update and other track should also do so that the method chosen is working properly and has not resulted in additional loss to the company. The hedging techniques also involves the transaction risk and cost, but some methods also secure completely against the exchange rate risk. The future and forward contracts. The future and forward contracts are the contracts which fix the rate at which the required foreign currency would be purchased or sold at a predetermined future date. This helps the company to fix the rate at which the foreign currencies will be required to be received or paid at future date. Thus, the net receivable or payable is known at the time of agreement and the company can plan accordingly. The agreements entered both in future and forward agreements are similar, and the only difference between both are that one is traded over the counter and the other is from the market. The benefit of entering into such agreement is that the net gain or loss that is to be incurred by the company on completion of the transaction is known on the given date. The business operation decisions or the management decision can be taken more effectively. Suppose the company A is having a payment in foreign currency of $100 for 5 months from now. The company has two options. One, that is wait for 5 months and when the amount becomes payable, would purchase the required dollars from the market at the given rate, which may lead to exchange gain or loss at that time. On the other hand, the company would use any of the hedging method like entered into a future contract today to buy $100 after 5 months at a predetermined rate today, so that the net gain or loss from the transaction can be known. After entering into the future contract, the company would be unaffected by any change in the dollar rate as against the base currency. Thus, the exchange risk would become nil for the company. The options hedging. The option hedging is also a better option to manage the exchange risk. This method allows the company to enjoy a particular appraisal or depreciation without worrying about the other side. This is done same as the derivatives trading, where the actual delivery of the underlying stock may or may not take place, but the actual settlement would be done based on the difference in the price of the underlying stock. Thus, in the above example, since the company has dollars payable, then the increase in the exchange rate of dollars would impact the company. So, the company would take a call option, that is betting on the higher side. Thus, the loss incurred after 5 months on purchasing the dollars from the market would be set off from the gain accrued in the options trading. The premium is also required to be paid at the time of entering in the option trading. Leading and lagging payments. The method of lagging and leading the payment is also very effective. This involves adjusting the foreign currency payable and receivable in such a manner the receipt of the foreign currency is used to pay the payable amount of that currency. This eliminates the requirement of the exchange of the currency in the home currency is not required. This saves the transactions cost, conversion cost and also is time effective. The time period for receivables and payables are to be negotiated in such a manner that the exchange is minimal required. Home currency invoicing. To avoid the exchange rate fluctuations, the company, if is having the superiority power that can influence the supplier to prepare the invoice in its base currency rather than the local currency in which the supplier is dealing regularly. This is called home currency invoicing. Since the company is the market leader or in the above position, the influence could be made which saves the company from exchange rate fluctuation, and the whole burden of the risk is to be undertaken by the other party. Let us conclude it now. The exposure to the exchange rate has been analyzed and various methods for managing the rate has also been known. The practical challenges still prevails in managing the exposure and depending upon the scale of transaction of the company in the foreign currency. The gain or loss from the currency fluctuation also impacts the financial results of the company. The transaction in the foreign currency can be of any nature. The company acquiring assets on lease in foreign currency or having a credit arrangement in the foreign currency would require regular or daily monitoring of the transaction and recording of the same. Proper studies by the experts are required to predict the expected change in the currency rate that may occur depending on various factors. The publicly available information as well as the unpublished price sensitive information, if available, should be analyzed and used for the determination of the expected rate of currencies. The exposure of the exchange rate risk should be monitored in such a way that the company is able to gain from the foreign exchange fluctuations. This has huge market full of potentials which can help the organizations to grow over larger areas of operations and make the benefit of the economies of scale to gain and meet the organizational goals more effectively. So, that is all for today. Hope you have understood. We will meet in the next episode with a new topic for your understanding of international financial environment at a deeper level. Till then, take care and goodbye.